So as a financial planner, the year end is always very important to me. I think there's a lot of good opportunities that at least we should discuss and talk about before that calendar flips, and then you can't do anything about some of these moves. These are moves that could benefit you from a tax perspective, and so I just want to point out I'm not a tax advisor, I'm a financial planner. I know taxes are incidental to our industry. We talk about taxes a lot, but I'm not a tax advisor. You should definitely talk to your CPA or a tax professional before you consider making some of these moves. Number one thing that should be on your radar as the year end approaches, the holidays are almost here, should be charitable gifting. So charitable gifting, obviously there's a great need in the communities. I can think, the food banks are stressed out. There's been a hurricane recently, a lot of great reasons to give. Doesn't also mean that you couldn't benefit yourself as well. And so from a tax perspective. So I think it's important to talk about the concept of itemizing deductions. So what that really means is that if I have things like property tax, charitable donations, could be some medical expenses, things like that. If all those total up to being greater than the standard deduction, which you could take on your taxes, then you're going to probably itemize. You're going to list all those things separately, and you'll benefit from a tax perspective. If I don't itemize deductions and I write a check to a charity, it's great. It helps out the charity, which is the main goal, but it really doesn't benefit me from a tax perspective because I may not be itemizing my deductions. So I just want to show you as far as the standard deductions this year for 2022, married filing jointly is $25,900. If you're a single filer, it's $12,950. That could be a pretty big hump to get over if you're trying to itemize deductions. You probably most people just take the standard deduction. But I want to give you an example. This is what that might look like. This is a piece of a tax report that I did for a client some time ago. Notice the standard deduction isn't the current one; it's the $25,100. It's increased since then. This is probably from a couple years ago. But you'll see there that there's some charitable donations, mortgage interest, property taxes, which are capped at $10,000, healthcare expenses. In this particular example, they had a total of about $28,000. So versus the standard deduction of $25,100, they're able to itemize deductions. So if they were donating an extra dollar to a charity, that definitely benefits them from a tax perspective. Now, if I was way under this, if I didn't have all these deductions and I wrote a check to a charity, it helps the charity, but doesn't really benefit me from a tax perspective because I'll probably just take the standard deduction. But anyway, you should definitely consider giving charitably toward the end of the year. The organizations really need that help, and if you're able to do so, I would definitely encourage that. What can you give away? Obviously, you can write a check to a charity. You can also donate securities, like if you have appreciated stocks or mutual funds, things like that. I mean, it is 2022. Market's been down substantially. A lot of those gains have been wiped out, but you may have some legacy positions that still have significant capital gains in there. You might want to consider giving those stocks away instead of writing a check. And so I think that's a really good option. You're giving away those capital gains. You're not going to pay tax on that. You get a deduction possibly for the amount of the value of the stock that you give, and then the charity, they get the money. They're not going to pay tax on those gains either. So it's a win-win situation. So a pro move would be, hey, let's say I was going to write a check for $5,000 to a charity. Well, instead of doing that, maybe I gift away some highly appreciated stock to that charity, let's say $5,000 worth, and I don't pay any tax on those capital gains, neither does the charity. Then I take that cash I was going to otherwise write a check for, and I buy that stock back, and guess what I have? I have a brand new cost basis. So that's a real pro move if you're considering writing a check, and you also have some unrealized capital gains in a stock or mutual fund, consider giving those away. Also, just on the subject of charitable gifting, I just want to mention if you're over 70 and a half, you can do what's called a qualified charitable distribution from your retirement account. And so you can actually gift up to $100,000 of your IRA account, and the charity gets the money and you don't pay any tax on that. So it's especially important when you turn 72 and you have that minimum required distribution that you have to take out. You have to pay tax on that money. You can gift up to $100,000 of that to charities or a charity, and it will count towards your MRD for the year, and you don't pay any taxes on that. So a case I would make to you, if you can't itemize your deductions and you're considering donating to a charity, and you're also, have to take that RMD out, that's a no-brainer. You should definitely be using your IRA money to gift to a charity, because if you just wrote a check to them, you don't benefit at all. It benefits the charity, but why not donate IRA money? Because that way you can avoid paying taxes on that, and it'll satisfy your RMD. So I think that's a great idea. Another thing you could do is regarding your property tax. There's a concept called bunching. We usually pay our property tax once a year, but you could pay. Let's say you paid your property tax in January. You could also pay next year's property tax in December. You maybe do this every other year. It gives you a bigger tax deduction because you're paying 2 years worth of property tax in one tax year. So maybe every other year you could do that. Now keep in mind, you have to actually have been assessed that property tax bill before you can pay it in this calendar year. So I'd have to wait till I actually get my property tax assessment this year before I can pay it for next year. So anyway, that's something you should at least consider. Tax loss harvesting. This is another concept. If I have taxable investments, it's been a bad year. I know it's been something that it's kind of like making lemonade out of lemons. Nobody wants losses in the portfolio, but if there are there, you might want to consider selling investments at a loss, and I can use those losses to offset capital gains. If I don't have any capital gains this year, I can certainly carry those losses forward to future years. I'll have a capital gain at some point in the future. This will come in handy. I can offset those. So tax loss harvesting. A lot of advisors, including myself, we do that on a monthly basis, or maybe throughout the year we look for opportunities to tax loss harvest. In an ideal world, there wouldn't be any losses, but if they're there, it's basically moving from one security to another, and I'm taking the loss, I'm staying invested, and then I can use those losses to offset capital gains somewhere at some point. Another good thing you could do at the end of the year is check on your mutual funds. Mutual funds in taxable accounts are notorious for year-end capital gain distributions. Basically, that's the result. The fund managers are buying and selling securities inside the fund throughout the year, and then they have to pass along those capital gains to shareholders. So sometimes, like a year like this year, where you may have a loss in your fund and then you get hit with a big capital gain that you have to pay tax on, that's like a double whammy. And so if there's an opportunity, the mutual fund companies will publish the upcoming capital gains estimates in advance. So you can look up whatever fund company that you have a mutual fund with, and you can see what's the estimated capital gain distribution. So you can make a decision before it happens. You can say, hey, I could sell this fund and avoid this distribution. Of course, that might trigger taxes, so you have to weigh the benefit. Hey, avoiding this capital gain versus selling something at a profit, I may have to pay. What's the lesser tax bill? What's the best way to go? So anyway, it's something that should be on your radar if you own mutual funds and taxable accounts at the end of the year. Another thing is that every year you might want to consider bumping up your 401k. Maybe let's say you're doing 7%, bump it up to 8%. Maybe just see if you can do that on an annual basis. If you're not already maxing out your retirement account, it could be your SEP IRA, your 401k, 403b. Bump it up 1% and just see how it goes. I'd be willing to bet that you may not notice that in your paycheck. So if you bump it up a little bit every year, it's gonna kind of out of sight, out of mind. It may not seem like such a bad thing, compared to bumping it up greatly. So if you're not already maxing out your retirement plans, bump it up just a little bit at the end of the year, and that's a good practice at the end of the year. Another thing you could do is a Roth conversion. Let's say, I have an IRA, and what I could do before the end of the year, I can convert part of the IRA to a Roth. So let's say I took $1,000 out of my IRA and I convert it to a Roth IRA. That means that $1,000 is taxable to me as ordinary income this year. But guess what? Now that money's in a Roth, and after 5 years, that's the aging period, that money is completely tax-free. It could grow to infinity, and it's going to be tax-free. So I think if you're, depends on your tax bracket. You might everybody's got to assess that for themselves, what that tax bill is going to be. But it could be a benefit to you to convert some of your IRA money to a Roth before the end of the year, because you can't do it once the calendar trips. So something to definitely should be on your radar. So there's just a couple things off the top of my head that I'm thinking about toward the end of the year. So you should definitely schedule a meeting with your tax advisor or your financial planner, whoever you really trust, and please work with somebody that knows what they're talking about. You don't want to make any mistakes regarding some of these issues, and so it's really worth it to work with the experienced professional. So if I can answer any questions, my contact information is in the About section of my YouTube channel. And thanks for watching my video.